Evidence session on the Bank of England inflation report and the UK's economic relationship with the European Union. I'd like to thank the Governor for responding to the committee's request for an updated economic analysis of scenarios for our future relationship with the European Union, and we're now publishing this document and it'll be available on our website shortly. Gentlemen, can I ask you to introduce yourselves, please?
Jonathan Haskell, Imperial College and Bank of England.
Mark Carney.
Andy Holder, the bank's chief economist.
Jan Vliega, external member.
Welcome back, gentlemen, to the committee in these strange times that we live, so strange that I'm chairing the meeting.
Seems entirely natural.
Governor, is the economy stagnating?
Well, if we look over the course of the year, this year, there has been volatility in the data because of BrExit preparations, because of stock building by companies, because of shutdowns and of car production activity, then restarting. If you look through the underlying trend, our judgment is that the economy is growing very weakly, slightly positive. But close to zero.
In the letter that you've sent us, would it be fair to conclude that the one change of real note is that the worst case scenario that you previously outlined has been reduced somewhat because of preparations, output loss down from 8% to 6%, and if so, if Parliament extends the ability to do preparations to the 31st of January, would that have any impact on your analysis?
I think it's a fair characterization that what we have seen, our assessment is that the preparations that have been put in place since November, not just at border in terms of border infrastructure, but also initiatives such as the TSPs, the temporary permissions, the improvements on the derivative markets that we've negotiated with the European Union is another example. And the impact of that has been to reduce, in our judgment, the worst case scenario. Now, remind that this is a worst case, not the most likely scenario. There is more preparation that can be done, both in terms of public preparation and preparation by businesses. And so it stands to reason that if there were more time, more would be accomplished.
And in your August inflation report, you're presuming a smooth transition rather than a no-deal BrExit. How would that change if there was no deal Brexit in terms of inflation?
Well, maybe I'll start. Our judgment, as is referenced in the report, that in the event of no deal, it would be likely that the economy would slow, the exchange rate would fall further, and inflation would rise. So directionally, it's relatively clear what would happen to the main macroeconomic variables, what would happen to the direction of the overall economy. There are substantial uncertainties about the orders of magnitude of all those factors. And of course, as you know, and you know better than we do, no deal means different things to different people, because no deal can be as simple as leaving on with no arrangements, side arrangements in place, but also could involve some side arrangements being put in place, as we have done with respect to key aspects of the financial services sector, and as I see the European Union has extended today, for example, in air transport.
I asked you, Governor, in December about food prices, and you said they could go up as much as 10% following a no deal. Is that still your advice?
Yeah, things have changed since November. The most important change since November is the government's released its tariff schedule with much lower tariffs than the common European tariff on food in particular. So when you adjust for that, back in November, applying the European tariff to the basket of UK food added about 5 percentage points. So almost half of that 10%, in effect. And the balance is a judgment about where the exchange rate could go, because there's almost immediate and full pass-through of movements in sterling to food prices. Now, with the new tariff schedule, on whole, there's wide variance depending on the specific food items, but on whole, on average, the tariffs are very low. They're on average about 0.3 percentage points as opposed to 5 percentage points on imported food. And so almost, effectively, all of the impact is an exchange rate impact. But given the market's judgment, market moves, and the likely level of exchange rate move that would happen, has already happened recently, but would happen in the event of no deal, the scale of those exchange rate moves would mean that most, not absolutely every, but most food prices would increase, but in the order of around 5 to 6% percentage points. So again, lower than it was in November, but substantial still.
And will that be a permanent increase?
It would be a level increase, yes. Yeah.
If we leave on the 31st of October without a deal, what will you do?
Well, there's several aspects of the bank's response, and of course, in these types of situations, many of the most important things are done in advance. So the preparations for the financial sector have been put in place, and we can go into more detail if the committee wishes on those. But the bottom line is we believe the financial sector is ready for BrExit. The core of the UK financial system is ready for BrExit, whatever form it takes. And actually, in the letter that I sent to you, Chair, there's some greater detail about that using the stress tests and potential impacts of a hard Brexit on the bank capital position. I'll just refer to that in general terms. So the first thing is what we've done in advance in terms of preparedness. Secondly, it is that core set of measures to ensure overall financial stability does not mean market stability. And we would expect fairly notable market moves. We stand ready to provide liquidity to the system as necessary. Major financial institutions have already pre-positioned collateral with the Bank of England that would allow us to lend up to £300 billion to them to make sure the system continues to function as it should. The Financial Policy Committee has indicated that it will consider, if appropriate, cutting the countercyclical capital buffer, as we did around the time of just after the referendum. That buffer is larger now than it was then. It's a percentage point of capital, so that releases up to potentially $300 billion. It happens to be the same number, but up to $300 billion of balance sheet lending capacity. And to put that into context, last year in this economy, overall credit to the private sector was £65 billion. So it's a considerable firepower for the banks to lend to the economy. And then the last component of the response, potential response, would be of the interest of all of us here, is the setting of monetary policy. And what we have said consistently, and I'll finish with this, is that policy response would not be automatic. We're not going to pre-commit to a policy response in advance of Brexit, whatever form it takes. We will have to look at the impact on demand, supply, and the exchange rate and take a judgment at that point in time. We would look to provide the support we can to the economy to smooth the transition as much as possible, but it's all subject to our remit to provide and maintain price stability.
And Dr. Flieger, Professor Haskell, in that scenario, what indicators would you be looking at in terms of giving your advice and making decisions? What are the big indicators that you'll be looking out for?
The framework for thinking about this is there's a short-term disruption effect on the supply side, and there's a longer-term potential adjustment of the economy to the new realities. Then there's the exchange rate that drops, which is going to result in inflation going up temporarily. And the really big question for us, which is what we will be looking at a lot of indicators for, is what happens to demand, sentiment, confidence in the economy. So you can think of ranges from people see the disruption and they say, yes, but that's okay. We knew there was going to be some short-term disruption. It doesn't really influence my longer-term plans. Or people see the disruption and say, actually, this is not what I was expecting. This is worse. And they make big adjustments to their consumption demand, or firms to their investment demand and to their employment. So these short-term indicators of economic activity will be very important. And then, which will take a little bit longer, indicators of prices. So are prices just going up in line with the exchange rate effect, or are prices actually going up by more because all of a sudden there's lots of costs that are going to be incurred by companies that weren't going to have to be incurred before. And so this magnitude of disruption, sentiment, demand, confidence, and then, which will take a little longer, the price impact.
Anything to add, Professor Haskell?
No, I'd agree with that. I suppose I'd just say two things. One is, as you'll know very well, the bank's got an extensive network of agents, and all of us on the committee, I think I can speak for all of us on the committee, spend a lot of time and commitment going around talking to the agents and getting real-time information from them. That's one thing. The second thing is that in the era of big data and the internet and all of that, the Office of National Statistics have been doing a lot of work on trying to bring forward very fast indicators of GDP and economic activity in general, most notably by getting VAT information, which enormous numbers of firms are obviously involved in, and using that VAT information to have very quick diagnoses of what's happening to the economy. So I'd look at those indicators as well.
And Governor, how fast sterling would have to drop before you intervene?
Well, our regime in the United Kingdom, which has served the country very well, is to have a floating exchange rate. The bank has never, and the MPC by extension, has never intervened for monetary policy purposes. I think we have to recognize that this situation, Brexit, whatever form it takes, will represent a real adjustment to the economy for a period of time. Relative incomes in the United Kingdom will be lower than they otherwise were. There will be a terms of trade shock, again determined by the nature of the final arrangements, no deal or some form of deal, and the exchange rate needs to adjust accordingly for that. And let the exchange rate do its job, and us to focus on ours, which is to maintain price stability, and in doing so support the economy, support jobs and growth as best we can. So I'd underscore that we've never have done it. I would also draw attention to what happened around the referendum when expectations in the market, they were wrong, but expectations in the market put very low weight on the outcome that occurred as late as 10 o'clock at night. The evening of the referendum, probabilities at least were around 20% that the vote would go the way it did. The market adjusted very quickly once it realized the vote was going the other way. It was an orderly market. There were high volumes. There were big moves in sterling, but it moved to a level that was consistent with, at least at that point, the market's assessment of the new economic realities. It subsequently adjusted those expectations further as the potential outcome of Brexit has shifted. So we don't want to get in the way of that. And it would only be in the most extreme circumstances with respect to market functioning that we could contemplate any activity. But we haven't seen it. We didn't see it under the most severe stress.
What do you mean by the most?
Well, the most extreme circumstances would be that the market is not functioning for some reason that, to be candid, I can't contemplate, but never say never. So it would be a situation where there were very low volumes, there were large price gaps, bid-offer spreads became very wide, and there was actually a dysfunctional market. As I say, the huge test of the market with the referendum, which is quite different than the process that is unfolding right now. So it's very hard to envision, and we would not intervene, to be clear. I don't contemplate, at least I can't see a circumstance that we would intervene either for market functioning purposes, never say never on that, but I would, at least on a personal basis, say never for monetary policy reasons.
But if you did need to, have you got the tools, the reserves, and the authority you need to take action?
Yes, we do.
You do?
Yeah.
That's very clear, thank you, Ian. Today's spending review, is that going to have any impact on interest rates? Mr. Haldane, perhaps bring you in.
You see, we haven't had very much time to digest the details just yet. We're really in the ante-room as we were coming in. So truth be told, we need as a committee to sit down and go through that in much finer detail than we're able to so far. I mean, some of what was announced today had already been in the public domain for a little time, but there's some new stuff as well. We need to go away and look through that in much greater detail as a committee, run it through our models and reach a judgment. It's just far too early for us to do that today, I think.
I mean, the committees, should there be at Parliament on Monday, is calling the OBR to give evidence, because the OBR has not been asked to do anything in relation to this spending review. Is that a good principle, Mr. Haldane?
That the OBR should be tasked with looking at this. I mean,
But they haven't been.
They haven't been so far.
No, there's no OBR report with it. It hasn't happened before.
Well, I mean, as a matter of principle, the OBR would put on earth do this sort of thing. So, in that sense, I'm sure they will, when they next report, look at that question. Maybe alongside what might be announced subsequently on the revenue and taxation side of things. This is a slightly unusual fiscal event outside of the normal timetable. So I'm sure in the fullness of time, the OBR will come back to this question and provide their assessment.
I mean, Governor, would you share what might, I don't know if it will, but it might be a committee, Treasury Committee view that this should not be setting a precedent for any Chancellor in the future, that there should always be an OBR report as the appropriate principle?
Well, I think the operative principle to answer that question is separation between monetary and fiscal policy, and respect the dividing line between the two.
Are you going to stay on, Governor, in the current circumstance?
I'll be here for as long as you needed me today, Chair.
The way Parliament's going, we keep it to the 31st of January, but that coincides, I seem to recall, with when you were off to pastures new. Have you? Are you going to reconsider?
I have,
if asked,
as you know, Chair, I have extended twice in order to facilitate a smooth transition. And there's two components of that transition. One is having a system ready for BrExit, a financial system ready for BrExit. We have put in place, the institution has put in place, I believe, all the most important measures for that. And the second is to transition to a successor who will be chosen by the government of the day. And the first is in place, and the second remains to be filled.
So you'd be leaving actually at what could well be the Brexit deadline day. You'll say minute.
Well, at present, I'm leaving months after the Brexit deadline day.
If that changes, what impact in terms of the appointment of your successor and handover? It does strike me that there is a bit of an issue there. You've outlined. There is a scenario that we could have some kind of cliff edge on 31st of January of some kind, and that the role of the Governor and the whole operation, of course, will be very important. Is this something, should Parliament wisely or unwisely change, that you'll need to consider?
I think the government, it's a decision for the government in terms of appointing a successor and the timing of that, and have every confidence that they will be able to do so. And it's the job of the bank to fulfill its functions, whatever Parliament decides, and we will do that as an institution.
I can recall, Governor, when you first came in,
Yes.
young and full of enthusiasm. Has Brexit made the job unappealing to applicants wanting to be a successor? That's an unfair question of you, so let me ask the two externals. Do you think it's a more unappealing job for a potential governor, Professor Haskell?
I don't actually know. It's all part of the part of the landscape. It's part of what the governor's got to do. So I don't think it's more unappealing. Actually, no.
It's more challenging, but the kind of people who want to become governor of the Bank of England, I think, would relish a challenge.
And does more challenging mean that there needs to be someone there as the next governor with full knowledge of the workings of the system? In other words, are we in a particularly unusual time because of Brexit that means that stability in terms of a knowledge base is more important than it might have been when Dr. Carney was first appointed and we were in somewhat more stable times?
I don't think so. I think anybody who fills that role needs to understand all aspects of the system, monetary side, the financial stability side, the interaction with the regulatory side. So I don't see that is different. It's just, if you enter the job in a period of stability, then obviously that's a different set of challenges than when you enter the job when the economy is potentially undergoing a significant structural change.
Thank you. Roshanara.
Thank you. Good afternoon. So, Governor, from everything you've said so far, you are confident that the UK leaving the EU without a deal won't result in instability in the banking system and exacerbate any downturn that the UK economy faces. Is that right?
Yes, that the core of the financial system is ready for Brexit. But I add
then that includes a disorderly Brexit.
It includes that, and as consistent with the letter that I sent to the committee yesterday to the chair, to reinforce that point is to take our assessment of the economic impact of a disorderly Brexit, map that to the hit to our bank's capital positions, because they would make losses under that scenario, and demonstrate that actually we have been stressing those institutions to more severe scenarios, domestic and global scenarios.
Yeah, and that letter sets out that although there's a slight improvement, it's still not great, with unemployment still expected in the worst case scenario to be about 6%, and you mentioned earlier that the scenario for growth would be still 6% down. Can you just put all of this in the context of a potential global recession and what it would mean for a disorderly Brexit?
Well, I think the first thing I just want to reemphasize, I know the committee knows this, but I want to read it into the record, is that these scenarios are worst-case scenarios. They're not the most likely scenarios, and the reason we use worst-case scenarios, particularly as the Financial Policy Committee, is to make sure that, the system needs to be ready for the worst that can be thrown at that, which goes directly to your question, because when we think about the system's readiness, it's not just about readiness for Brexit, but it's readiness for the possibility that things could go wrong abroad and have quite substantial implications for markets and for our financial institutions, who are all very global. And in terms of, so we have looked at a severe recession in China and the knock-on effects of that through the global economy. And in some respects, it's not exactly the case, but in some respects that is a worst-case trade war scenario. So we have stressed the system to that and made sure that it's adequately capitalized and has adequate liquidity for it. I should say that, from our perspective, or maybe I'll speak personally from my perspective, the global economy has the reacceleration of the global economy that we had expected by this point in the year has not transpired. We think the most likely reason for that, at least I think the most likely reason for that, is the fact that so-called trade tensions have shifted into an actual trade war between the two largest economies in the world, and the scale of tariffs are now considerable. But also, there is beginning to be a marked impact on business confidence, not just in those two economies, the U.S. and China, but more broadly, given the interlinkages with the rest of the world. And that's starting to impact, very importantly, the manufacturing sector. I think it's safe to say that we're close to a manufacturing recession across the advanced and important bits of the emerging world, and has had knock-on effects, not surprisingly, on trade. But we need to put all of that in context, that the context being that when this trade war started, the global economy was growing well above trend. It was quite a healthy recovery in terms of business investment and growth on trade. That has shifted, but it hasn't shifted to a point that portends, at least in my judgment, a global recession. The bar for a global recession is actually quite high, and there's some ways to go.
How so?
Well, the reason for saying that is that the fundamentals in the major economies are still relative. I'm going to give the glass half full and then the caveat. The fundamentals in the major economies are still quite strong. So there are pockets of risks in the major economies, but you're not seeing excessive credit growth, whether on the household side or on the corporate side. Inflation is under control in some respects. It's too low in some economies, which gets to a point I'll make in a moment. China is the exception here. There are quite significant imbalances in China, which are a cause of concern. So the interaction between the trade war and developments in China could move us towards the type of situation we looked at from a stress. The caveat, the most important issue, is that there are challenges. There are two important issues. One is that there is challenge to the nature of the trading system in its broadest sense. So this is an unusual circumstance in the last several decades. And then secondly, that there is relatively limited policy space for most of the major central banks and to some extent the major governments. And so it's the risk that we move to much slower growth, and there's a limited ability to offset that. I would end with this, which is that we still have considerable policy space in the UK, and the nature of the Bank of England means that there's not just policy space in terms of conventional monetary policy, also unconventional, but there's also policy space in terms of macroprudential policy if needed.
So just to cut to the chase, what you're saying is that at the moment we're not, we've got some way to go towards if we head towards a global recession, but you're not ruling that out given some of and things have changed quite dramatically. A year ago, trade wars won't have necessarily been mentioned in the equivalent sessions that we've had with you. Within the space of a year, we've moved to a different place. If you can just set your mind on the prospect of a disorderly Brexit, either at the end of October or at the end of January, and try and explain to us which of those dates, presumably, given what you've said already, by January, what should we be expecting in relation to the global economic scene and a disorderly Brexit, and what does that mean for the UK and are you saying that the central bank, the Bank of England, is prepared for those eventualities, for a possible global? What people will want to know is whenever that comes, whether it comes around the same time or soon after, or even a year after, are we insulated? Do we have the apparatus to be able to cope with a global recession? And what does it mean for the British people?
Yeah.
Can you try and explain that?
Let me pick up a few of those points. First, I would characterize the global environment has become more difficult. It's less supportive for UK growth. That's absolutely clear. And that it faces some unique challenges. The global economy faces some unique challenges, which are principally but not exclusively related to the ongoing trade war. And it is a trade war that has some possibility of spreading to other jurisdictions, including Europe and by extension the United Kingdom. So this is a less supportive backdrop than we've experienced at any other point in the last 5 years. At less supportive backdrop than we've experienced since I've been here as governor. Let's put it that way. The second thing is that we and the UK is one of the most open economies in the world, cannot be insulated by developments internationally. There's nothing that we can do. We can help offset some of these effects, but we can't insulate and fully protect the economy. And in fact, there's various ways to model a trade war, but if there is a deepening of the tariff actions and persistence of those, and if there is this effect on business confidence outside of the United Kingdom and therefore business investment, the potential hit to the UK is one of the least affected major economies because we're not directly in the sights of this trade war, but we would probably have an impact on the order of 1 percentage point or a bit more than 1 percentage point. Put that into context. The impact on the
more than 1 percentage
or 1.25, 1.5 percentage points.
That's significant.
But it's significant. But to put it into context, the impact on the United States would be more than 3 percentage points if this persists. I mean, that's our modeling, and that's.
And does that factor in a no-deal Brexit?
That doesn't factor in a no-deal Brexit. So this is independent of that.
Right. So what's the combined impact?
Well, again, speaking from we do not have a forecast for no-deal Brexit. We only have the worst-case scenario, which is not what we think is most likely to happen in a no-deal Brexit. So I wouldn't want to mislead by adding the scenario to the trade war because the probability of that trade war effect is probably greater than the worst-case scenario of Brexit.
So it could be half of the 1%.
I'm not going to be pinned down on a specific number. The point, to get to the core of your question, is that is the system ready to withstand both, the financial system? In our judgment, it is, because that's exactly what we've been stressing it to, and of course we've left a fair margin of an additional buffer of capital and liquidity. And I would remind that the major UK banks now have £1 trillion of liquidity on their balance sheets, plus access to us. But the economic, there would be serious economic implications if both were to occur at the same time.
Yeah.
Yeah.
Okay. Just sorry. Did anyone else want to add to?
Just on the world. I mean. It's easier right now to see risks to the downside, and they plainly exist, not least from trade. Yeah. But let's also put into context how much of an easing of monetary policy has already happened during the course of this year. You're back up to the tail end of last year, and most of the central banks around the world were planning, and financial markets were pricing, a further tightening in policy. You fast forward to today. We've already seen, global yield curves in the UK, the US, and the euro area fall by a whole percentage point over that period. That provides extra stimulus to the system. Indeed, that is the reason why in our forecasts in August, we saw growth next year in the world bouncing back a little bit. Not at a stellar rate, but from around 3% this year up to middle 3% next year and the year after. Now, that's not all one side. There are definitely the balance of risks for me would be the downside for the reasons the governor says. Equally, there is stimulus in the pipeline, the effects of which we'd expect to be registering around now and through the remainder of this year.
Okay. So just going back to Brexit preparation, is there anything else that the bank still has to do before the 31st of October that it hasn't done, including, of course, and also is there anything that the government needs to do as per legislation that's still outstanding? Now, I'm thinking in particular in relation to the derivatives market and uncleared derivatives.
Yeah.
And any recent developments you want to share with us, and data sharing. Perhaps, Governor, you can start.
Why don't I start? I think the first thing is to say is that between now and October 31st, we are engaged on daily contingency planning for Brexit, daily supervisory interactions with major financial institutions. So we're tracking things, and there will be issues that, because we're tracking on a daily basis, there will be issues that come up maybe with individual institutions from time to time that we'll be on top of and address. So we're not just sitting back and waiting for the date. The second is that, as you mentioned, there are some unresolved cross-border issues. Uncleared derivatives is an example that it's really in the hands of the European authorities to address those, and specific national authorities, both in France and Germany, are the concentrations.
And what are the amounts?
They're considered north of, in a notional, they're around 23 trillion of uncleared contracts that are affected. I can write back and give the precise number.
How confident are you that there'll be agreement?
Well, it's not. It's within the responsibilities of those national authorities. There is legislation in place in both jurisdictions that has to be applied in order. And then there's other ways to address it, which is to change the counterparties and move the arrangements. But in our judgment, that will not be. There's not sufficient time to do all of that. And that gets to the third thing, which is moving clients from the UK to the European entities, and there's various progress on that. If I can just say a couple words on legislation, though, because
sure.
You raised it. The first is that I commend the committee's role in this. The Parliament has passed over 50 statutory instruments that are relevant to the financial sector, and so has put in place the framework that's necessary. The consequence of that has been that we've authorized more than 400, one of the consequences, more than 400 entities to make sure that they can continue to serve UK and global clients out of the United Kingdom. So that's all the good news. I should flag a couple of issues that are still outstanding. One, you'll be well familiar with the so-called in-flight files bill, which is the financial, I'll get the precise name for it in a second, but it's the Financial Services Implementation of Legislation Bill, and this is for things that have changed since the acquis was onshored. It's not urgent, but it's important because over time it will undermine some of the coherence of the legislation. So, and that will, my understanding, will, as you shift parliamentary sessions, when that will need to be reintroduced. That's the first thing I wanted to mention. The second thing is that the SI with respect to state aid does have some potential relevance for some liquidity provision that the bank might provide in extremely rare but extraordinary circumstances, although we are in extraordinary circumstances. And so, all things being equal, a lane of that SI, when appropriate, would be preferred. I should, though, take the opportunity to reinforce that we have 300 billion of facilities up and running that are not affected by this, plus we have just received a capital injection by the Treasury this year, so we also have balance sheet capacity above and beyond that 300 billion.
And on data sharing, there was a report about the disruption to UK's role as 174 billion global data hub. Did you want to add anything?
Well, it's. I mean, the UK, as you know, has recognised the framework, the data framework of the EU 27. That has not yet been reciprocated, and so companies, including importantly financial services institutions, are having to rely on so-called model clauses, legal fixes, temporary legal fixes to this, recognizing that under GDPR, which still applies, obviously, in the European Union, that if those fixes are not in place or are not robust through time, there are quite severe potential penalties. And of course, there are enormous costs to separating pools of data. So this is, I think, I'll take the opportunity to say it's in the interests of both sides to have this resolved in an enduring way. Is it likely to get
resolved before the 34th?
It's a question for the government, but I have nothing that suggests that it will be resolved.
So we could see massive disruption on data if we leave the European Union, have a disorderly Brexit, a no-deal Brexit by the end of October.
I think,
and also in relation to the uncleared derivatives of 23 trillion.
On the derivative side, the issues develop after we leave. We do think it's in the interests of European Union first and foremost, but both sides, that a fix is put in, a enduring fix is put in place there. With respect to data, I will say that for the major financial institutions, that they have been addressing with the second best solution these issues, which is to put in place model clauses, these legal fixes around data sharing, and that in that regard there should not be disruption. It's an issue that could potentially come later.
But there will be with data.
Again,
if there isn't an agreement by the end of October.
Well, there is unlikely to be an agreement, and so the first best solution is an agreement. The second best solution is firms take some legal risk and have these model clauses, which allows them to continue operate effectively
but on data,
as before.
They haven't.
No, on data they have been doing that on a individual firm basis, and the largest institutions, the most sophisticated institutions, are in that position.
But others aren't.
But others, not everyone will be.
So
and it's also, if I may, it's not a. To give you a sentence on it, it's less a cliff edge issue at the core of the financial system, but it is not a sustainable set of fixes to what is a fundamental issue to the functioning of this
society.
economy.
Yes.
Yeah.
Thank you.
Alice?
Just move to ask something before we move on to the questions that I had, because I was on a lot of the statutory instrument committees previously, and there was one before the summer where the government had to come back to correct a statutory instrument because there had been some error in it. I was wondering if there was anything from your own point of view that you are assessing the adequacy of those statutory instruments as they reach you to make sure that what was intended is actually what is there for you.
Nothing that I'm aware of. Our understanding is the ones that have been made that pertain to the financial sector are effective. And I'll just refer to my earlier comments on state aid, which is the one that's outstanding, that it's principally about other things, but has some ramifications, potential ramifications for us.
Okay. And how do you, I was also speaking for my party on the sort of in-flight bill as well, and how important do you feel that is to have that in place? And if that's not in place by the time we have, if we have a no-deal Brexit, what impact would that have?
From our perspective, from our responsibilities, it won't have an immediate impact. We have the authorities we need. It I think, is potentially has some ramifications. I'll defer to the FCA to speak to that, but in terms of MIFIR and other instruments, it has some ramifications there. But there's elements of, with time, it will become more important. Now, of course, with time, our whole system is could change, but it's a question of if it hasn't, the coherence needs to be there. I mean, one area, for example, is around the sustainable finance program and green taxonomies and other things, which is something that, consistent with the government's and Parliament's strategy, it's desirable to have that in place. But it's not a short-term financial stability issue.
Okay, that's useful. Thank you. Can you tell us, are any of the impacts of leaving the EU likely to be made worse if the UK leaves shortly before or after a general election?
Pass. How's that for an honest response?
In the inflation report press conference, you'd said the preparations by government businesses for no deal cannot eliminate the fundamental economic adjustments to a new trading relationship that a no-deal Brexit would entail. Can you explain to us a wee bit more why both fiscal and monetary policy, along with preparations carried out by businesses, are unlikely to mitigate all of the negative impacts of no deal, and what more can be done around that?
Well, this is a fundamental question, and an important one, which is that the change in the trading relationship affects the supply side of the economy, not just earlier Dr. Valega was rightly speaking about the impact on confidence of households and business and demand and activity. Are they spending? Are they investing? Are they hiring? But there is another impact of Brexit, which is unusual in our sort of professional lifetimes, which is there's a very large, and there's no other way to put it, but there's a very large supply shock that happens at the point of Brexit. And of course, if it's a no deal, no transition Brexit, it's an immediate shock where the economic relationships change. And certain activities are no longer profitable, they're no longer economic, and that, whether that is that affects plant and equipment and the uses of that plant and equipment, and it affects people who are trained up and working in those sectors. And even though this economy is one of the most flexible economies in the world, it will take some time to adjust, to reallocate the capital that's there and retrain the people that are also there into new roles. And monetary policy does not have an impact on that. It can affect the demand, it can affect the financing conditions for businesses that need to invest, but it won't make a factory that is solely there for the purpose of producing a car part for a European automaker that is no longer economic. It will not change that, and it also won't change in the short term the capacity of at Dover. It doesn't matter what level interest rates are at or the degree of quantitative easing that's in place. It will not change. It will not increase the proportion of throughput through Dover. Other steps have to be taken. So you have, and I think Professor Haskell referenced before that we have the sort of disruption element of Brexit. Think throughput at ports. That's potentially relatively short term, although difficult during that period. But we also have this impact on supply, and to some extent, if you want another D, you have disruption and you have destruction. You have destruction of some of the supply of the economy, and we can't impact either of those. What we can impact is the third D, which is demand, and so that judgment, when we say the shorthand of the impact on supply, demand, and the exchange rate, is we're judging about to what extent has demand adjusted more than the supply side, and can we support demand? Are we appropriately supporting demand so the economy comes back to its new balance? But everything that I talked about on the supply side is that fundamental adjustment about which we cannot affect.
Okay. Professor Haskell, do you want to pick up on any of that?
No, just to echo that. I mean, as I mentioned earlier on, I and other members of the committee go and talk to firms all the time. And if you say to a firm, if a car company says to you, I'm really worried about financing conditions and banks are dysfunctional and I can't get money to invest and all that kind of thing, that's something that potentially, the bank can do something about. But as the Governor's just been saying, if that car company says, well, unfortunately, because of, the inability to strike deals and this, that and the other, our just-in-time flow of production, that business model is just gone. All the capital stock we've invested, which gives you flexible production, just-in-time production, all that kind of thing. That's just useless anymore. Again, I hope we're very sympathetic as a panel, but there's nothing that the committee can do about that. So I'm sorry, I'm just furiously echoing the Governor's words, but maybe just to add a little bit of colour to that.
Yeah, that's fine. The bank's analysis from last November indicated that GDP would fall between 5 and 8% in your no-deal scenarios compared to the November 2018 forecasts. Can you give us a bit more on your update on those figures and why you feel those have changed?
Sure. There's several improvements that account for the difference, and in fact they're detailed in the letter. But the first is that issues around port capacity and customs capacity have a material impact. So our expectation back in November was that the reduction, and this was broadly consistent with the government's expectations in terms of their analysis, that there could be up to, and remember that this is a worst case scenario, not the most likely, but there could be up to a 3/4 reduction in the throughput through the major ports if there had been a no-deal Brexit at that point in November. Now we think that reduction is less than half. Okay, so that's that is quite a substantial shift. A kind of rule of thumb: every 5 percentage points of capacity that comes through our major ports, think Dover and others, probably gives you back about a 1/4 percentage point of GDP. So that's it's material moving between those two numbers, and that is a direct result of hard work both in the UK, but also some investments, particularly in Calais in France, to put in place additional capacity, because it's obviously all linked. So that's one of the most important. Ms. Ali was asking earlier about derivatives. There was this, and she was asking rightly about uncleared derivatives, which isn't fully solved, but there's also a bigger pile of cleared derivatives, and subsequent to November there was an agreement between an arrangement between ourselves and the ECB and the European authorities that have addressed issues around cleared derivatives, and that is added. That means that there'd be less disruption in financial markets. To bring it to the doorstep, lower mortgage costs and lower financing costs for households and businesses in the United Kingdom. In addition, the degree of uncertainty, we've taken things that have improved the degree of trade that would happen. Also these improvements on the financial side, and then made some judgments about that those should also have knock-on effects, positive knock-on effects in financial markets, so that the cost of borrowing won't rise as much, the risk premium, to say it in another way, won't go up as much on UK assets, and also the degree of uncertainty that's affecting business and household decisions won't go up by as much. Now those are obviously judgments, but when you add them up, those are the principal components that have improved the analysis. I will say, though, that to go back to the earlier question, the more difficult global environment and European environment, because the European economy is being hit quite directly by these global trade issues, has meant that that's taken back some of the benefits. So as we slow, the knock-on effect on Europe, and then that spills back to us. Again, in a worst-case scenario, that is something that's, in our judgment, material. So there's real progress on the ground. There's real progress in terms of the financial system, and then that has some positive knock-on effect on confidence and on financial markets as a whole. All of that adds up to around 2.5 to 3 percentage points of GDP that we would not otherwise lose, which is the good news. And again, I'll just repeat my caveat, which will be ignored, which is this is all a worst-case scenario, not the most likely forecast. Okay.
Thank you for that. If we end up leaving the EU without a deal on 31st of October, is your more pessimistic, the disorderly scenario, more likely to become the reality? And if we end up in that scenario, what do you think the impact would be on output rather than the smooth transition that had been modelled?
Well, there directionally, whatever form Brexit takes, there will be a material adjustment to the existing relationships. It is absolutely in the interest, and we've said this from day one, that given the scale of the adjustment, even with quite a comprehensive deal, it's absolutely in the interests of UK businesses and the UK economy as a whole, UK citizens, to have a time of transition to adjust. Every single trade deal signed in the last 40 years has at least an 18-month transition, normally an average between 2 and 4 year transition to the trade deal. Okay? This is a trade deal in reverse, which in many respects is harder because you're not building new relationships, you're taking apart some of the relationships. And it is clearly undesirable to have that adjustment happen overnight. Now, it may transpire that that is what happens, given other constraints that are in place. But in terms of the economic impact, a smooth transition or a period of time for businesses to adjust to the new realities would improve economic outcomes. And you see that, and if I can, you rightly refer back to November, the committee had asked us in November not to look at had asked us to look at a transition to a WTO, you know, the smooth transition scenario, not a forecast, from recollection, is something on the order of 2.5 percentage points decline in GDP, which is, you know, so somewhere between that and somewhere between the 5.5, 6 percentage points we're talking now, is you know, a considerable. It's jobs, income, and welfare in between the two.
Okay.
Catherine.
Thank you, Chair. I just wanted to go back briefly to a question that the Chair already asked you, Governor, because earlier this year the GMB trade union published figures suggesting that the average family shopping bill would increase by £800 a year, or 17% in the event of a no-deal Brexit. And then academics at Warwick and Bristol universities, they forecast that food prices would also increase as a result of a fall in the pound, as a result of a no-deal Brexit, suggesting the average weekly grocery shop would increase by about £670 a year, so £58 to £71 a week. I know you have already given an indication of where you think that likelihood lies at the minute, but do you think those figures are in the right sort of ballpark? And in real terms, what does it mean in terms of a no-deal Brexit for people's food bills?
In terms of the second part of your question, it is likely that food bills will rise in the event of a no-deal Brexit. As I said to the Chair's earlier questions, that is almost exclusively, overwhelmingly, because of the exchange rate impact. And what we do find consistently that movements in the exchange rate are quickly translated onto the shop shelf. And actually, what also tends to happen is that domestic food prices also rise. Imperfect substitutes also rise alongside, so there is a bit of a knock-on effect there. That impact has lessened since November because of the new tariff regime that the government has put in place.
But would that impact the inflationary impact or the impact from the pound, the tariffs?
The tariff impact, the tariff impact on inflation is relatively modest. And speaking personally, I would also say that we're more likely. I personally would be more likely to look through the tariff impact because what happens with the tariffs is they tend to be passed through one time, And so there's not much one can do about that because monetary policy acts with a lag, whereas the movements in the exchange rate, the pass-through tends to happen to prices over the course of several years. It's faster for food, longer for other elements, and so it happens over that horizon. And therefore monetary policy has to take it into account. I guess the point I was working up to on food prices is, since the referendum was called, the exchange rates moved about 25% total, called, not had. And so we are seeing some of those impacts in terms of food prices already. It's possible that certainly market positioning indicates that the exchange rate would likely move further in the event of no deal, and that would show up in the shops. To your specific, I'm not going to, if you will, I wouldn't mind just writing in quickly on the household impact of that, the numbers, rather than trying to do it in my head.
That would be really helpful. Thank you. And is there anything that you've seen in terms of the no-deal Brexit preparations that would mitigate against those increases that we are expecting to see to food prices and to other household items?
Well, I think the fact that since November that our sense of the traffic that can go through our major ports, the fact that that's gone up quite significantly, that will help mitigate it. It will certainly help mitigate any potential shortages of items of food. And if further progress is made in that regard on both sides of the channel, that would be welcome. In our calculations of the food price impact, we've done something that's more mechanical, which is to say, how much is the tariff? That adds in, for the basket as a whole, 0.3. How much could the exchange rate move? That adds another 5 to 6 percentage points. You add those two together. It doesn't do a micro calculation of, well, what if there's shortages of certain foodstuffs, and then you have higher price increases as a consequence of that. So the improvements in the functioning of trade, that is a direct answer to your question. That has improved the circumstances. Yes.
Okay, but just to summarise, regardless of any mitigation there may be in terms of tariff increases, that is not going to take away the increases that people are going to see as a result of the exchange rate and the pound fluctuating as a result of a no-deal Brexit.
That's correct, yes.
Okay, and that would be helpful if you could give us the figures. Thank you. I just wanted to ask as well about the UK's output data and it contracting by 0.2% in the second quarter. And on the same day, the Office for National Statistics released the information. The Chancellor described the economy as fundamentally strong, citing high unemployment, high wage growth and national debt falling as a percentage of GDP. Would you agree with his assessment that the economy is fundamentally strong?
Few things on that. First, in terms of maybe I'll refer back to my comments to the chair earlier about the underlying pace of growth. So, first quarter, unnaturally strong, 0.5%, or appeared stronger than the underlying pace was, and that was because of stock building on both sides of the channel, a few other things, autos as well. Second quarter was stronger than it looked, or less weak than it looked, maybe is a better way to put it, because of the give back of those factors. Yep. We get some knock-on effect in the third quarter, but overall, at least my assessment would be that the underlying pace is weak, maybe slightly positive, but close to zero in terms of performance. But stepping back in terms of some of the fundamentals, certainly the labor market has been very tight. Record employment, as you note, record low unemployment. Wage growth as high as it's been since the crisis, just under 4%. Very high levels of vacancies, so companies are finding it difficult to find the workers they need, which is a sign of a tight labor market. And then on top of that, another fundamental I would point to in terms of the resilience of the economy is that the underlying financial positions, particularly of households, are very much improved. British households, UK households have worked hard over the last decade to pay down debt, to improve their financial situation. It hasn't been easy, I recognize that, and they've done it in an environment where it's only recently that real wages have started to properly grow. But it does mean that they are in a better position than they would otherwise have been if there is going to be a period of relative weakness in the economy.
Okay, so it doesn't sound fundamentally strong. The bank's August forecast for the UK GDP was flat in the second quarter. Did that come as a surprise to the bank? Did the size of the decline?
The size of the decline it was mild. There was some
little bit. It was largely a stocks thing, though.
Yeah.
It was a little bit more.
We had more of the stocks, that's right, drawn down than we would have expected. Because logically, I mean, for what it's worth, our logic and plus some of the intelligence was obviously with perishables, you had to, food and veg, you had to move the stocks out. But for others, carrying them forward through to October might have seemed more likely, but that's not what happened. And so that. But I would say, again, speaking personally, that looking through all those ups and downs and that sort of noise, that I think the economy is softer than I would have expected a few months ago. Yes.
Okay, and presumably,
as is the
you'll
world,
be downgrading your forecast for the October deadline, or it will not come as such a surprise in terms of the stockpiling for the October deadline and the reaction that will, whatever comes in terms of whatever outcome on October the 31st. Presumably you are taking that into consideration, or will be, having learned from the last deadline and the unexpected size of the decline that came about from that one.
Yeah.
Are you making any adjustments?
Well, we'll have to make lots of adjustments. The next forecast will be challenging. Yeah.
Okay.
I mean, one just on the stocks point in particular, and one reason why any potential build-up in stocks out of the end October deadline might be a little different than the build-up in stocks in the run-up to the end March deadline is that you're getting nearer to Christmas, and the capacity to warehouse stocks for Brexit-related reasons is somewhat constrained in the run-up to Christmas, given that Christmas is also a reason to be running up. So we may see a less large build-up because of simple factors such as warehouse capacity in Q3 than we saw in Q1. And of course, some stocks, as the Governor mentioned, some companies have held on to the stocks they built up to end March. Some have run them off, but a number have held the line, and about a third, I think, plan holding more coming up to the year end.
And just to drone on about stocks for a second, the last consideration is that it's relevant the stocks of European companies as well, because many of the stocks that people will want to put in place are imported anyways, so there's not a net add to GDP. But if it's an export to European companies, then and we have, surprise, we don't have any agents in Europe, and so we have less visibility on what the European companies are doing.
Well, speaking of your network of agents, I do also wanted to ask about the regional agent survey and whether you've detected any differences in terms of businesses being ready and preparing, and what expectations they have of Brexit, but in particular a no-deal Brexit, and whether you're detecting any differences in terms of different regions and the potential impact. Don't mind.
So I can start. We think about it primarily in terms of the sectors that are more or less exposed to Brexit, and of course different regions across the UK have different concentrations in different sectors. Some have bigger concentration in agriculture, some have bigger concentration in manufacturing, and so the headline list of vulnerable areas are food and agriculture, chemicals and pharma, and transport and car-related things. And so in areas where you have a lot of that, you have people who are more worried than average, and areas where you have less of that, and you have people who are less worried than average.
Do you think it would be helpful to, rather than just focusing on sectors, but to actually have the ability to summarise business conditions and the impact on a regional basis as well as a sectoral basis?
We have data on that. Whenever our agents report on their area, we have numbers on regional GDP, regional income, and so we have those things to hand. I think it's important to emphasize the fact that our mandate is for the country as a whole, for inflation in the country as a whole. And the regional analysis would be useful if that helps us understand the country as a whole. But in the case of your specific...
fundamentally that's my question. Would it help you understand the country better as a whole if we were to get a better use of data on a regional basis as well as a sectoral basis? I mean, as you know, the Treasury Committee has launched an inquiry into regional imbalances, and in July, I mean, we discussed this. You said that the North East, the North West, Northern Ireland, the West Midlands are the regions that will be most affected by Brexit, while London and the South East will be least affected. And I guess the concern is, what are we doing, and are we doing enough to make sure that not only are we preparing ourselves for Brexit nationally, but also making sure that each region and the challenges it will pose are being properly addressed? Or are we going to see an increase in regional disparities?
Well, I mean, to that, I mean, the reason we mentioned the regions back then was based on having done the sectoral analysis and looking at how which sectors would be affected most. And you're talking cars and transport, you're talking chemicals and pharma, you're talking food and agriculture. You can then map from that sectoral picture to which regions of the country would that affect most, and we can do that, and that was the basis for what we said back then. I mean, one more general point is that, I mean, my strong sense, and I think this probably echoed across this side of the table, is that our regional network of intelligence has been absolute goldmine during the course of all matters Brexit. I cannot think how we would have got our heads around the extent of preparedness by companies across the UK had we not had that 10,000 strong network to draw upon and to ask some very specific questions about their state of readiness and about which aspect of their state of readiness was more or less advanced. We have already, most of that data is already available in the public domain. We're always looking for ways in which that data can be made even more useful. Regional cuts are one dimension of that we can take away and think about a little more. Certainly from my perspective, you know, that cut of the data can be very helpful in getting a window even on economy-wide developments, and has been over the past few months.
If I could just add to that, I mean, I think that's right. I mean, one of the things about many of these business surveys is they're actually often on a rather small number of observations. And to add to the agents that Andy Haldane was just talking about, you know, we're cooperating with the University of Nottingham and Stanford University on the Decision Makers Panel data set, which is which asks 8,000 firms, you know, every month, you know, information, a different sort of texture of information to the agents that you were just talking about, Andy, but nonetheless asking them about, you know, when do they expect, you know, Brexit uncertainty to be resolved, you know, so a similar set of associated questions. Now, because that is a large data set, one can then cut that up into the different regions in a way that you couldn't in any of these smaller data sets. So I think we're making a number of steps, as say, along with academic researchers, to try to bring this, to try to bring us to a position where we have data sets so that we can make these regional cuts that before we might not have been able to have done.
Would the production of regional inflation rates help the MPC with its work?
I think it would help, and I know the ONS are on the case on doing just that. It's a long-standing gap in our fiscal armoury, that we don't have good deflators at a regional level. We tend to take a national deflator, I think, to them as things stand. That would certainly help in not just us, but I think the city and other analysts to get a picture of what's going on. So yes, I think the NBC would be a consumer of that data as and when it became available.
And what could you realistically do with the information, given monetary policy is generally national lever?
Well, I think the first thing, I mean, it's exclusively a national lever, at least as per the remit that Parliament gives us. I mean, you change the remit, obviously we'd have to change. I'm not sure how we would exactly implement it on a regional basis, but it's exclusively a national objective. But one of the things you can, depending on the richness of the data, including on labor market data, sometimes housing market data, you can inform, and because of the differences in different regions, different points in the cycle, different regions, in part because they have different sectors that dominate in those regions, and there's different cycles for the sectors. It can help inform understandings about things like the relationship between tightness of the labor market and wage development. So it depends. There's a high hurdle for this, but at least can help inform about trying to construct regional Phillips curves and see where the pressures could be, housing price dynamics and other aspects for financial stability purposes. But I think to the spirit of your questions and to colleagues' responses, also just understanding the nature of businesses, business decisions, interconnections between supply chains on a national level, as well as the degree of flexibility and movement between regions. So where do you have tightness and perhaps less so? That builds a richer understanding of the economy, and that's only to the good, even though monetary policy is ultimately for national purposes.
Okay,
and I think, but can I reinforce something that Mr. Haldane said, which is that what under his leadership, what we've tried to do is to as we develop these additional tools to make them certainly to expose the analysis, but also to try to make the data sets available so that other researchers, other observers can use them, and whether it's the decision-making panel, which is in my view quite innovative, or the regional data sets, that's very much the direction of travel. So the greater interest of the TSC and other researchers can be satisfied in that way.
Right. Okay. Great. So to that end, I have just one final question, which is: should or could the bank have a role in reducing regional inequality, and will you be submitting evidence to our inquiry?
Well, the best contribution that the Monetary Policy Committee can do to promote or to reduce inequality is achieve low, stable, predictable inflation. The high and variable inflation affects those least well off the most. Others have an ability to protect themselves against that. As the bank as a whole, what we can do is to make sure that or do our part to promote a financial system that reaches all aspects of the economy. And I would just draw attention to the Future of Finance report, and particularly the Bank of England's response to the Van Steenis report, the Future of Finance report, which has a number of initiatives that address issues that quite often have a regional dimension to them. And I'll stop on this, which particularly SME financing. Small, medium-sized enterprises across the country face a financing gap, in our estimation, of more than £20 billion per year. So these are companies that are creditworthy, that could finance, could expand, but they can't get financing from conventional means, from the banking system. There are now ways to potentially provide considerable competition in that sector and additional finance to them, and that will have, our judgment, I think we probably need to scrub it a bit more, but it's likely that would have bigger impacts in those otherwise underserved regions than London and the southeast.
But that would be a byproduct of that policy decision rather than the aim.
Well, I'm not sure it's a byproduct in the sense that within the secondary remit of the Financial Policy Committee is to support the development of productive finance. We don't have the principal responsibility for that, but this is something that, and we don't have all the tools to do it either. But I think by developing an approach there and doing what we can to influence it, and I can go through the plumbing of that another time if you want, of what we would do to support a new financing system for SMEs. I mean, I think that's pretty, it's more than just something, that's kind of the purpose of it as opposed to something that just happens.
Rebalancing the economy in terms of regional disparities, you
Yeah.
are suggesting is hopefully a byproduct of that approach rather than the aim of it. The aim is to increase the productivity of SMEs.
We don't have distributional.
Yeah. Well, the question is, should or could you have that role?
I think my personal view is that the core responsibilities of the bank, which are considerable, monetary and financial stability, are foundational to improving inequality outcomes and reducing regional disparities. But the bigger levers are the responsibility of government and Parliament, ultimately Parliament.
Okay.
Just on that point, maybe just, I don't think we do, as the Governor was saying, have the tools ourselves to affect change to those disparities regionally. The policy tools. We do have some of the analytical tools that can help make sense of them. Indeed, we've deployed some of those tools, not least in assessing the impact that our own policy actions are having at different points in the distribution, income-wise or regionally. So analytical tools, yes. Policy tools, I think, no. And we're happy to deploy our analytical tools to help make sense of these things.
I think, Mr. Allen, it would be useful to get just a very brief note to the committee on regional inflation rates and how that would, what that would look like and how that could come about. I think that would inform our inquiry. So if that's possible, that would be helpful.
I'll happily take that one away, Chairman.
Thank you. Ali.
Thanks. It's a very interesting discussion on the regional issues, and hopefully we'll take that further in as part of our inquiry. I want to ask about shocks. Obviously, some of the questions that we're asking relate to the potential for a large shock to the British economy, particularly if the UK leaves the European Union without a deal. Just a precursor to my question, when we say a shock, I think just for the benefit of, I'm sure there are many people who are watching this session fascinated, given all that's going on in politics today. By shock, we don't mean a surprise, do we?
It could be a surprise, but we don't. No, we mean a large change. It could be anticipated or unanticipated.
And will there be a difference if by shock we mean large change and unanticipated, or large change but anticipated?
Anticipation of a shock, depending on how far-sighted businesses and households are, can allow preparation. And by the way, to be confusing as central bankers, when we talk about shocks, we talk about the positive and negative shocks. So if something really good happens, that's a shock. It's just if something happens that is not the base case expectation. So they call it the dismal science for a reason.
I mean, none of us call it that, right?
No.
But just to be clear, we have positive shocks and negative shocks.
Yes, I know. I know. To be absolutely clear for everybody's benefit, the specific shock of the United Kingdom leaving the European Union without a deal, we anticipate that being a negative shock.
It is in the short term, so the policy horizon of the MPC, which is 2 to 3 years, we anticipate that it would be a negative shock for output and employment. So in other words, employment would be lower than otherwise and output would be lower than otherwise. but a positive shock for inflation. In other words, inflation would be higher than otherwise, in large part because of the exchange rate effect.
And what can you give us a sense of the magnitude of the shock?
That's the £10,000 question. We, as the MPC, we do not have a forecast of a no deal, no transition Brexit, because up until our last forecast, that has not been the policy of the government, and it has not been the most likely scenario. We'll have to take stock in November for the November forecast of where we stand as a country and adjust our forecast accordingly. What we have looked at are scenarios. What we have provided this committee with are scenarios. One of those scenarios, the worst case no deal outcome, disorderly outcome, was we'd already prepared for the purposes of the Financial Policy Committee. You asked for it, therefore we gave it to you. The other two scenarios which you asked for explicitly, which were a smooth transition to a transition to a WTO relationship. So a shock that is anticipated, to use the language you've been using. So there is a transition for a known end state. We, as the bank, not the MPC, but as the bank, we formulated that and provided it to this committee.
Okay, so you mentioned earlier, Governor, the difference in the state of the markets now and their treatment of Brexit than at the time of the referendum. So could you give us a sense of how much you think the possibility of no deal is already priced in?
Okay. Yeah, so that's an important point, which is that in the run-up to the referendum, just to recap, markets as a whole were expecting that the vote would result in the UK remaining in the European Union. And in fact, as it got closer to the vote, that expectation hardened. And so markets were positioned very much that the UK was likely to remain. Not everybody in the market, but most people in the market were positioned, or the weight of positions was in that direction. So there was a shock for the markets in that the vote went to leave, and there was a very quick adjustments. The markets did their job. They functioned in an orderly fashion and repriced a variety of assets, most notably sterling. Where we sit today is that markets have increasingly, since the spring, been pricing in the probability of no deal. It is tough to get a direct read on that. There's various ways to estimate them. The crudest way is to look at the betting markets, which got the referendum quite wrong, I would note, but have been at least directionally consistent with the way the markets have been moving. That's a relatively thin market. So in other words, the probabilities can move around fairly substantially. In fact, they moved quite substantially in the last 24 hours. And could obviously change again very quickly. But in essence, in broad strokes, the probabilities, including, and I will reference external commentators, so economists from investment banks and investment houses that give their own assessment of these probabilities. In general, the probability of no deals for external commentators, external betting markets, financial market asset prices, if you average those, somewhere around, in the spring, somewhere around 15-20% probability that no deal would happen, rising up to around 40% as of yesterday. That probability has gone down somewhat in the last 24 hours, but as I say, can move around very, very quickly.
Okay, but would you say that what we're looking at really is we need to be aware of the change in the fundamental situation in the British economy rather than problems created by unexpected events?
We need to do two things. One is we need to prepare the financial system. One of the bank's responsibilities, the FPC's responsibility is to prepare, is exactly that, is to prepare the system for unexpected events. And in fact, even though we construct scenarios, it could be a recession in China, it could be a trade war, it could be a deflationary scenario, we construct various bad scenarios to see how they would affect the financial sector, but we're pretty confident that what hits the financial sector will not be one of those, it'll be something else. And so the system needs to be anti-fragile, if you will, so to use Taleb's description, right? It needs to be, be able to absorb shocks that are unanticipated, and by stressing the system to a variety of different things, it makes it more likely that it will be robust, resilient to the thing that actually happens. Now, in the case of BrExit, it's a different issue. It's an anticipated event, and the way we've addressed that, again, as the Financial Policy Committee, is to say, let's not worry about what's most likely to happen. Let's just think about the worst that could happen and prepare for that. What's happening, and then if I can bring it back to the MPC and how we conduct monetary policy, what matters for us is not what we think is going to happen, so we don't spend time on thinking of what we think is going to happen, but is how businesses and households and financial markets are behaving, which is influenced by what they think is going to happen and the implications of that. And so in the cases of businesses, what's been absolutely clear for some time is that they're deeply uncertain about what is going to happen, that they see, and this is borne out by the surveys that we've been talking about previously, that they see in the event of no-deal Brexit quite a sharp reduction in their output and quite a sharp reduction in their employment and a rise in overall prices. That's what they think. And so is one of the consequences of that has been that investment has been stagnating over the course of the last few years, which has been one of the biggest influences on economic performance.
Okay. Just to turn to the specifics of inflation, you said that the committee's interest rate decision in response to no deal would need to balance upward pressure on inflation from the likely fall in sterling and any supply shock with the downward pressure from any reduction in demand. So does the recent increase in the inflation rate to 2.1% in June make monetary loosening in response to no deal less likely?
Well, we certainly take into account the most recent figures, nor would we want to put too much weight on 1 month's inflation reading. Would note that inflation came in at 2.1%, as you know, a headline core inflation at 1.9%, that most of the upside surprise in inflation, if I can change the terminology, came from the most volatile components of the CPI. So recreation, think video games. It was a good month for video games, except for the prices if you were trying to buy one. Transportation, and clothing and footwear. So those three components really accounted for all of the upward boost on inflation. That said, consistent with the discussion with Ms. McKinnell earlier, there are elements, particularly in the labor market of the economy, which are pretty tight, and unit wage cost growth is very high, actually, relative to past performance. And so domestically generation inflation is pretty firm right now. Now there's reasons to expect that may come off as the economy, if the economy continues to perform as it has been recently, but we certainly take it into account. And that brings to the fore a point I want to make, which is that the conditions going into October 31st are different than the conditions going into June 23rd, 2016, by which I mean inflation is at target, including or just slightly above target. Core inflation is around target. The economy is around full capacity, maybe slightly below, but around full capacity, whereas in June of 2016, inflation was very low, and there was substantial slack in the economy. And that meant that there was a lot more room for the committee to act and act as it did. Now, all that said, I have said in the past, my personal opinion is that on balance, I think that it's more likely that I would vote to ease policy in the event of a no-deal Brexit than not. But it's not assured, it's not pre-committed, and there are limits to our ability to provide that support.
Does anyone else disagree?
I'm sure they do, but...
On the bottom line, absolutely not. But I would underscore the points Mark makes about the here and now being rather different in terms of underlying cost pressures than what it was back in 2016. We had a more than 1% percentage point output gap then. We had wage growth at 2 and a little bit. It's now almost at 4%. We had unemployment close to 5%. It's now sub 4%. That was a rather different cost environment than the one we're experiencing right now. Inflation expectations in financial markets, at the same time as the world has suffered a prospective kind of lowflation problem, and inflation expectations have headed south. Ours have been pretty steady, and a gap has opened up between us and the rest of the world. So I think given our remit, we have an inflation target. We cannot overlook cost developments like that, and that would have to weigh in the pot if it did come to a no deal, no transition Brexit.
Yeah, Dr. Deegan.
I agree with all that. That circumstances are importantly different. There is one other set of circumstances that are different. Is that when we were talking about the prospects for the economy after the vote, we were talking about things which were entirely about expectations of changes that would happen some way into the future. Now we are talking about things that might potentially happen the next day. And so there was never any prospect of immediate supply disruptions on the 24th of June because no laws were changing, no regulations were changing. Now we are talking about potential immediate impact. And so it's a very different consideration how people will react to something which may or may not happen quite far into the future to something which is right here and right now.
And just talk me through and therefore what? Like, what are the range of, how would that impinge on your...
So this brings us back to the discussion we had, I think, one of the opening questions from the chair, which is that we will be monitoring very carefully the scale of the disruption, which is, of course, important in of itself, but also important because the scale of disruption is likely to have an impact on people's confidence, people's demand, and we want to judge that secondary reaction too. And aside from how far is the exchange rate falling, what do we think that's going to do to inflation, all these things will go into the mix, but there is this important new element of the immediate supply impact which was absent the last time. Last time was only about expectations of a future supply change. Now it's about actually happening right now.
Okay, last question, Professor Haskell, if I may. You said about earnings growth that 3.6% in the growth in the quarter to May 2019 should exert upward pressure on inflation, but it may not necessarily happen. Just talk us through what you think the other considerations are and what might feed in to counteract that.
Yeah, thanks. So as a governor and Andrew Haldane have been saying, wage growth is very robust at the moment. I mean, that is one of the features of the economy. That's putting upward pressure on prices. And so other things equal, given that we've got the inflation target we were just talking about, that would cause us to act to bring that under control. Of course, what really matters is wages not only in relation to prices, but for our policies is wages in relation to productivity, in other words, unit labour costs. And you'll see lots of stuff in the inflation report all about unit labour costs and so forth. Now, the trouble is we don't have a brilliant fix on productivity at the moment. It's been extremely low. And so at the moment, our guess is that these are quite high increases in unit labour costs as well, which again would push you towards being inflationary. But that picture can always change. The productivity issues are always quite volatile. So that's the sort of first set of things. And then I'll end on this second set of things, of course, is, just because unit labour costs and wage costs, that there's been a reasonable amount of wage pressure in the past, just because that's been going on in the past, doesn't mean it's necessarily going to go on in the future. And you would have seen in the inflation report that firms have been extremely pessimistic. They've stopped investing. They're generally pessimistic about output growth. If that feeds through to the labour market, and there were some signs of that, I might expect those labour costs to come down a little bit, which would ease the type of pressure that there's been on inflation.
Thank you.
Thank you.
Thank you, Chair. Yeah, to pick up, I suppose, from that point, the bank's agent survey showed that even companies that considered themselves ready for a no deal thought that, as you're saying, output, employment, investment would be substantially lower over the next year than in than otherwise, relative to a scenario where there is a deal. Did your agent survey find businesses from any sector which were optimistic about the opportunities of leaving the EU?
Businesses from any sector were optimistic
about the prospects of leaving the EU without a deal?
I'll give you the honest answer, which is I don't know. I have the graph in front of me which you're referring to, which talks about all the different sectors. Can we get back to you on that?
Yeah, I think we'll get back. I think we should just be clear, though, that the question they're asked is in terms of the near-term horizon, so near-term effects, and so it wouldn't be a judgment of longer-term opportunities.
Okay.
I will be happy to have that information.
Yeah, that would be useful. I was curious as well because I got a report from the CBI through the post about what comes next. This report here, the business analysis of no deal preparations, and their sort of headline is that no one is ready for no deal. I was wondering if perhaps some of your agents are listening to people that are perhaps more optimistic, or really speaking to different people. Because the CBI's analysis would seem to be that nobody is ready and nobody is prepared for a new deal.
Sure. Wait.
Our numbers, I haven't compared samples. So we have about a fifth of companies who feel they're fully ready, and about 3/4 who feel they're as ready as they can be, meaning they've done what they can, but they recognise there'll still be some bumps, and about 90% who've enacted their contingency plans. So that would be slightly more optimistic than what you said there. I would make one more point about this, though, which is it's a good thing, of course, that more firms have got themselves prepared in various shapes and forms. We've been tracking that on a pretty much monthly basis for the last 12 months through our agents. Understandably, that has not been without cost, because it chews up a lot of managerial bandwidth if you're a small business, if you're doing this stuff. And the decision-maker panel work that Jonathan mentioned earlier on has looked into this and asked where have the costs of that shown up. And the obvious place where those costs have shown up is in lower reported levels of productivity by those companies. And the sorts of numbers we're talking about are a hit of something like between 2 and 5% by dint of companies having to put in this prep and contingency planning. So it's a good news story for how big the cost might be looking forward, but of course that's really kind of dragged forward some of the costs to ahead of the point of leaving.
I think the only thing I'd add is that, as has been mentioned, is we're continually talking to firms, and agree with Mr. Haldane's figures, and they're detailed in the report. The as ready as can be figure, which is the bulk, the 3/4, I remind that the view is that their output will go down, their employment will go down, etc. First point. Second is that in the last several weeks, there's been some shift of the I'm ready or as ready as you can be to I'm not ready, as we've been talking to firms. Now, I think part of that may well be that more and more information is coming out to firms of what they need to do. This is positive because now they have a better sense of what they need to do, and would appear in some cases discovering that they haven't, that there's more that's required in order than in a EORI number, for example, in order to export. It's good to have, you got to have one, but that's one of many things that are required in order to pull it off.
I mean, I think one thing, if I can just add quickly to that, is one of the interpretations of firms who are ready or as ready as they can be is they might still be terribly uncertain. They've done everything they can, but they're terribly uncertain. And as you'll have seen in the report, on most of the metrics, we've got firms report being more uncertain about the outcome and the outlook as well.
Yeah, aren't we all? The inflation report picked up on the EORI numbers and said that most of the 240,000 UK businesses that sold trade solely with the EU didn't have the numbers required, the registration required. Does this kind of low level of applications indicate that a significant proportion of those businesses who believed that they were ready as possible just weren't? And does that indicate a kind of wider, perhaps, sense of complacency or a sense that people haven't been told all of the things that they need to do?
Well, I think a couple of comments on that. One is that there is the 240,000 exporters. There's a long tail of smaller firms, and not surprisingly, smaller firms less informed about what's required. The second thing is that, as you know, the government is automatically registering all VAT firms, which should bring the number up to something like 150,000 or so out of that 240. Maybe it's slightly higher. The key thing then, and that's very positive. The next components, though, is that you need a duty deferment account. You need other. I mean, there's a series of other things that are required. So the key is not just to get the firms registered, which is a necessary first step, but to ensure that they know what else is necessary in order to continue to, as seamlessly as possible, act as exporters. So I would put the bigger the firm, the more sophisticated, the more likely they're ready or have truly done everything they can do. And then it's fundamentally a question of port capacity, if I can simplify, trade disruption and the underlying economics of the shift, both of which might be considerable. Just to put a fine point on it, the most sophisticated auto manufacturers in the world are ready, but entirely reliant on factors outside of their control. Whereas some of the smaller firms might think they're ready, but just don't know what they don't know. Yeah.
Would it have been perhaps helpful for the government if they had this information in the first place, just to automatically register firms in the beginning rather than waiting to such a late stage?
I think the only attitude has to be that we are where we are, and to improve things from where they are. And as I said, we would say that we have seen progress since November on a variety of factors, and there's been progress and further progress in recent weeks.
Yeah. Do you believe there's sufficient time to get the firms that are still outstanding registered from the agent reports that you're having?
I honestly don't know.
Okay.
Yeah.
Thank you. Wes.
Okay. Good afternoon, and apologies for arriving slightly late, but I'm not sure it was worth being in the chamber for the statement, but there we are. That's where I was. Just wanted to, I don't expect your view on that either. Turning to the bank's latest survey, suggesting that household expectations for their own financial situation has held up, even though expectations for the general economic situation deteriorated. I'd like your views on three things, really. Firstly, why do you think households are still confident about their own financial situation, despite having lower expectations of the general economic situation? And does this present an inflationary risk? And thirdly, to what extent does households' confidence about their own financial situation explain why consumption has been so resilient? Who would like to go first? Governor?
Sure, I'll start. Why don't I give the headlines and colleagues can provide the substance, which is that the confidence about, I believe the confidence about this dichotomy is because of the strength of the labour market. As we've gone over, it's not just low unemployment, very high employment, but actually very high level of vacancies as well. And you're seeing now job churn is gone back to historic levels. So people not only are confident that they have a job and that job isn't about to go away, but they could also move to another job. And actually, we had been waiting for that job churn to start to happen, because we had expected that once that started to happen, there would be wages would begin to firm because, and that's exactly what has transpired in the labor market. So there's that positive. Do people obviously people are affected by news about the general economic circumstance and the uncertainty around it, and one would expect also picking up what is happening in terms of the businesses themselves in aggregate that are not investing. They're hiring but not investing, so that provides some sort of generalized uncertainty. That first bit is linked to the third bit, which is what's driving consumption. It's growth in real incomes is driving consumption. So there's jobs and wages are picking up and more people have been in work. And so this is not a debt-fueled consumption boom. This is people consuming out of income and not beyond. And does it provide an inflationary risk? Well, it's one of the upward pressures on inflation is the firming of the labor market. Unit wage costs that we discussed earlier, so wages are increasing much faster than productivity is increasing, and that is providing support to inflation.
Any other contributions to?
Well, just a point of detail really, but the metrics you mentioned, Mr. Streeting, are one of our better indicators of retail spend. So consumer confidence is towards the top of our hit list of what best anticipates future spending, and within that, the category that asks people about their own financial position does a far better job of explaining their spend than does their views on the general economy. So what's happening to your own pay packet matters much more than your extent of doominess and gloominess about what's happening in the wider world. So that'll be consistent with the patterns of spending we've seen through the course of this year, which have held up pretty well, and in some extent have held up rather better than we were expecting.
I was just going to add a point about we have learned quite a bit over the last few years about the distinction between people saying they're uncertain and therefore generally unhappy about that uncertainty, and it actually affecting spending decisions. So right now what seems to happen in households is they have good reasons to be positive about their own finances. As my colleague said, unemployment is low, real wage growth is high, and that is underpinning consumption. They don't like what they read in the newspaper, political uncertainty, economic uncertainty, but it doesn't seem to be influencing their spending. There is a complete counterexample of that, which is we also know that firms are very uncertain about the political environment, their future trading environment. But we have very strong evidence that it is influencing their spending, even though the effect came through a little later than we thought, but it was every bit as large as we thought. And so what we have learned is that there are types of circumstances where uncertainty has a big effect on spending and types of circumstances where it doesn't seem to. And the households who have this dichotomy between, yes, they're uncertain, but they're still spending, is one example where it hasn't or hasn't yet come through.
And when we say they're still spending, is it affecting patterns of spending and spending behaviour? So, for example, I was talking to a car dealer recently, and one of his anxieties was about the number of people buying new cars versus people buying second-hand cars. And the trend, as he put it, people are buying second-hand cars because they're cheaper. People don't want to go for the kind of the stretch of buying a more expensive car, taking out finance. To a greater extent that they would on a second-hand car. Are we seeing those sorts of change in behaviour as a sort of small example?
We are to some extent. So we've seen, relative to overall consumption, we've seen durables consumption being weaker. So cars and houses have not done as well as overall spending. In the case of cars, there is also, some might be related to future income uncertainty, but there is also a tremendous regulatory uncertainty. People don't know what sort of cars will be taxed at what rate, and the regulations are changing in quite material ways, changing the cost of the ownership of these cars. So that added uncertainty is no doubt also having a depressing effect on car demand. But if you go to the housing market, house price growth has been slowing to nearly zero. Activity has been flat, and so that certainly hasn't looked like the kind of market that you would expect when you look at just aggregate consumption growth, which has been relatively better. So yes, we are seeing some distinct patterns.
Governor.
The only supplement that by noting that in parallel to these developments, the costs of mortgages and the mortgage terms have continued to improve for the borrower, and they're exceptionally mortgage conditions are exceptionally loose, shall I say, and despite that, and despite the confidence about their personal financial situation, the housing market has been relatively soft, and so this is where investment by a household, the biggest investment they're going to make, biggest purchase decision, buying a flat or a house, parallels what's happening on the business side, which people are holding off.
Sure. Okay, Dr. Vliga, last year you said that the UK's low savings rate made you concerned about the vulnerability of households to a downside surprise in income or employment. Does this mean you believe that consumption will deteriorate if the UK leaves the EU without a deal and growth is hit as a result?
You need to put a few more conditions on it than just leaving. What it means is exactly what I said, which is that if there is a shock to income, either directly through real income or via employment, I think there is an asymmetry in that people might respond more strongly to the negative side by cutting spending than they would respond to the positive side by increasing spending, because the savings rate is already so low. Now, if you want to tie that to a no-deal Brexit, then the question becomes, well, by how much is income going to fall, and by how much is the unemployment rate going to go up? And there can be scenarios where that is quite severe, in which case, yes, I would expect these asymmetries to be quite material and to affect our analysis. You can think of scenarios where people are relatively better prepared, and it's a downside surprise, but it's not that big, and therefore it may just be that we see consumption following income in relation to past relationships, and there isn't this extra asymmetry from the fact that the savings rate's already low.
And what would you say, sort of playing devil's advocate and being a good committee member rather than a partisan one, what would you say to the sort of the Prime Minister's note of optimism? There are lots of people out there who voted for Brexit, they still support Brexit. Could we place some hope in that they'll be very excited and optimistic? Steve will be out there spending like crazy. He's got his Brexit. Will Steve and all of those other Brexit voting consumers out there help to boost consumption, do you think?
I don't know. What I can say about that is it is actually something that we've looked into, the difference of behaviour from people in areas that were predominantly Leave and predominantly Remain voters. And what you see is a little bit of this overall dichotomy that we see in the confidence data, which is that people who are in Leave areas are more optimistic about the future than people who are in Remain areas, but they don't particularly spend more. And so there is that exactly that dichotomy that you see in the aggregate confidence data.
Okay, well, yeah, I mean, we could spend hours debating that. I just wanted to sort of conclude with one final question on this, and then a tangential question, if I have time, Chair. So obviously we've debated endlessly at this committee the relationship between productivity and wage growth. Thinking about sort of how things may pan out, do you see sort of a short to medium term scenario where, because of the labour market conditions that you described, we start to see wage growth increases, and that might then have a record on productivity growth, because firms can't simply rely on cheap labour rather than investing in their own productivity? Do you think that's something we might see?
It would be a conventional dynamic in this case. Yeah, wages leading productivity. The conditions for investment are there. Firms are near full capacity. They have relatively clean balance sheets. Financial conditions are very accommodative, and the world economy isn't as good as it was, but it's still growing. And price of labor is going up considerably, and there's been a pretty long period with relatively little investment, so all the conditions are there.
But we will see.
But we'll see.
Dr. Valiga, do you want to come in on that?
No, what I would say is, we've come out of abstract from the whole Brexit discussion for a moment, we've come out of a recovery which has been unusually investment weak and employment strong compared to previous recoveries. And so that's left us with in a number of years of underinvestment, which means just mechanically that there aren't as many machines for the workers that are there, and therefore they're relatively less productive. Now, it stands to reason that as you use up all the slack in the labour market and you start to see an increase in the cost of the additional worker, then firms will have an incentive to switch to investing more so that they can become more productive, and, if you will, pay for the productivity increase can pay for their wage increases. But you absolutely need the sort of economic circumstances that are conducive to make that investment, not just the higher labour cost. You need adequate long-run visibility so that firms are keen to make these investments. And for the moment, they are not at all. Investment intentions on our own agent surveys are at 9-year lows. Investment has been contracting 5 out of the last 6 quarters. The kind of environment that is extremely rare to see outside of a recession. So we are not there, but if you think about the next 10 years as opposed to maybe the next 1 or 2 years, then I think that mechanism, there is absolutely a reason to think that we can reverse this and have at some point a recovery which will be investment rich and employment poor, because the labour market's already close to full employment.
Sure. Conscious of time, I'll leave it there.
Steve.
Thank you. I refer to my registered interest in Glimp Pay, which is relevant to monetary policy. Can I first of all put on record my thanks to the Chairman of Court, Bradley Freed, who came to, as he offered to, came to John Hampden School in Wickham, and he was absolutely inspirational. He even inspired me on the subject of central banking, so I was very, very grateful to him.
I'd like to second that.
Yeah.
To my constituency too. I'm exactly the same experience.
Oh, absolutely brilliant.
Thank the Governor for visiting my constituency before the summer recess, which was inspirational for the teachers and the kids. And one teacher wanted to know what was going to happen to her mortgage.
Yes, exactly. So I wanted, because I'm rather afraid at the moment the UK has become rather short-term and insular, inward-looking, and I want us to be a bit more long-term and expansive. So I would like, Governor, to ask you about this excellent speech, which I think, frankly, is one of the most important subjects, as you know, long time. This speech you made at Jackson Hole Symposium on the 23rd of August, which I don't think has had anything like enough coverage. I just note in passing that in Chart 1, trade war is a top tail risk affecting global investors. I can't help noticing that BrExit happens to be at the bottom of the chart. There's something in here for everyone, Dr. Haldane, including a bond market bubble. I can't help noticing. But can I ask you, Governor, since this is 16, you gave a brilliant speech, but it's 16 pages of dense argument. I wonder, just for the benefit of the public, possibly this committee member, whether you might just give us a gist of the argument you're making about the growing challenges for monetary policy in the current international monetary and financial system.
Okay. Well, thank you for reading it and all the way through to the appendix. The challenge is that we have a fundamental asymmetry in the global economy. The U.S. dollar is the instrument for most of trade is priced in U.S. dollars. So more than 60% of trade is priced in U.S. dollars. A lot of trade in the UK that doesn't come from the US is priced in US dollars. That's true around the world. So 60% of trade is priced in US dollars. Almost 3/4 of reserves of countries are in US dollars. Financial instruments are largely in US dollars. And yet the United States is a diminishing share of the global economy. So it is now about 15% of the global economy. It's important. It's still the largest economy in the world. But it's not the 40% of the global economy it was after the Second World War and this system began to develop. And this doesn't matter in the circumstances when everybody's growing at the same rate or the US is weak and the rest of the world is relatively strong. But it starts to really matter when the US is relatively strong compared to the rest of the world, and U.S. policy is necessarily tightened, so monetary policy is tighter. And that means that conditions in most other economies are much tighter than they otherwise would be or should be for their own domestic reasons. And this challenge at the heart of the global monetary system has been increasing with time and is only going to get larger. And furthermore, it's amplified by some of the otherwise positive developments in the financial system. So banks are less important and markets are more important, but some of the core elements in markets are, or use a term, maybe not an everyday term, but UCITS, unit trusts, mutual funds, the same, different words for effectively the same thing, that give us as investors daily, not me because I'm not allowed to invest in them, but daily liquidity. We can put our money in and take them out, but they increasingly invest in illiquid assets such as emerging market debt and others. And that structure of the system makes it more fragile in these circumstances where conditions are tighter in the U.S. than the rest of the world. So there is this asymmetry at the heart of the international monetary system, and it is a fundamental and growing problem, which is adding to the challenge we talked about before you came in, which is that there's relatively little monetary policy space for most of central banks. I'll add that the Bank of England still has monetary policy space, but there's relatively limited monetary policy space because that lowers the equilibrium rate of interest. It makes countries save excess money, greater reserves, and it also makes the system as a whole riskier. So in a perfect world, we would change the system, make it less reliant on the US dollar, more reliant on a basket of currencies. We're far from a perfect world. And the last time we had a change in the monetary system was the move from sterling to the dollar, effectively, via the Bretton Woods system. And that was quite a bumpy transition for a variety of reasons. And there's every reason to think that the transition, if it came down the road from the dollar to the renminbi, would have similar challenges. And in any event, we would just end up with a system which has a single currency at its core, a hegemon, if you will. Therefore, what would be better? There's a variety of things. The speech goes through a variety of things of how we should function in this system in the short and medium term, because it's not going to change overnight, but then ends off with, to put on the table that since in history, what drives changes in the monetary system is how we transact domestically and cross-border, what we pay for goods. And since we increasingly pay for goods and services virtually online, that the unit of account that we use online, if we change that, and there's ways we potentially could, we could rebalance the system. And therefore, and I very much appreciate your raising it, because the purpose of the speech is to take a step back, draw attention to the elephant in the room that nobody talks about is there's this asymmetry. You talk about it, in fairness. Few people talk about it. But you're so upbeat and that it gets missed. The elephant in the room, a few people talk about, and start a debate about how we could potentially rebalance the system. It doesn't pretend that there's a simple answer.
I'm slightly conscious it's only a tail risk, but this could potentially be my last session. So I'm very pleased indeed that you've made this important speech about these issues. You do briefly set out the mainstream view in the speech, and you say that the mainstream current consensus in monetary thinking is increasingly untenable, and you go on to say that it's increasingly anachronistic. So do you, given the things that you've said here, do you think it's possible to avoid a long-term fundamental structural change in the monetary regime?
I think that there will be a change. I mean, now measured over decades, it's very hard to predict exactly. That which is unsustainable tends to go on for longer than you think, and then happen more quickly than you expect, to paraphrase Rudy Dornbush. But I think that these structural flaws in the end in the system will ultimately result in a change. And the rise of China, the relative rise of China, will also result in a change. So you have these two forces. And the question I'm trying to raise is, do we get ahead of that change, or do we help manage that change and affect some sort of rebalancing of the system? And to be absolutely clear, when I say we, I'm talking not about I'm talking about the central banks, the public side, as opposed to the private side, coming up with an entirely different decentralized system. Mm-hmm. So this is partly where we may part company at that point on the issue.
I'm all in favour of choice.
Yeah, exactly, in favour of choice, but just to be clear.
Thank you. So can I ask the other members of the panel if they share the governor's analysis in the speech, because I feel confident you've probably read it. If you haven't, do say, because I wouldn't want to unfairly grill you on something you haven't read. But Dr. Haldane, do you broadly share the governor's Freudian slip there?
I've read it. I've read it twice actually, and I do. Yes, I mean it's. Interestingly, I doubt there's very much strong pushback on the diagnosis. This asymmetry has been here for quite some while, at least since the breakdown of Bretton Woods. I agree with the governor that those tensions have become more acute of late, as many economies have become in some ways more dollarized, at least in terms of the debt that they issue. There's no question that the one of the solutions, and the governor floated one in his speech, the synthetic hegemonic currency.
Just trips off the tongue, doesn't it?
That's another three-letter acronym. Is definitely towards the ambitious end of the spectrum, but that is just now is the time for ambition on these big issues. So broadly speaking, I very much kind of share the diagnosis.
Thank you. Can I ask the other two panelists, Governor, first to come in, please?
Just very quickly, I'm very supportive of what's been said. It's a hard nut to crack because, as the governor says in his speech, these network effects are very strong. When everybody is using one currency, then there's an incentive for everybody else to use the same currency. So that's a hard thing. That's a hard nut to crack. But I share Andy Haldane's view
I agree with
now's
that.
the time
10
to be
years I've been
ambitious.
banging on about the international financial system. It's going to change, but here we are. We're making progress. Dr. Flagel, what would you like to add on the governor's speech?
So I made the same point about the impact on the global economy of an asymmetric tightening in the U.S. when the rest of the world is not doing as well. I made that in the beginning of the year as being a key source of the tensions that we've seen just in the most recent slowdown. Adding on top of the trade war, I don't really have anything to add on the long-term solution to this, but it's one of the things that we take into account when we evaluate the strength of the global economy.
So the governor wants to come back, then I'll work to wrap up.
I'll make a quick point, if I may, which is, and I want to link it back because you rightly started off on taking a step back, looking medium, longer term. Mm-hmm. And one of the things we've tried to do as a bank is to step back and think about, okay, where's the financial system going? We talked earlier about SMEs, but the payment system itself, and how can that be improved? There's a variety of ways that it is being improved, and there's others, but one of the issues, which links back to the speech, is whether or not there are going to be central bank digital currencies in order for there to be instantaneous, costless payments domestically and potentially cross-border, which would be to the benefit of citizens and businesses, and particularly small and medium-sized businesses, but all businesses. And the question is whether could that happen? And the answer is yes, it could happen. In fact, Mr. Haldane is helping to lead our efforts in thinking about how the various ways, and there's more than one way you could do it, and various avenues to do it. But the question is, if you do have that happen, does it make sense to do it on a coordinated fashion with some of the core central banks, which brings benefits in and of itself from a cross-border perspective, but happens to be a component of a more seamless rebalancing of how transactions are priced. Because, and I'll finish with this, it's not just about the financial spillovers, although those are incredibly important, and they're one of the reasons why the equilibrium interest rate is so low, and Dr. Galega in another speech pointed out that why the left-hand tail risk is higher. But it's the fact that a disproportionate amount of real transactions, purchases of goods and services, are priced in U.S. dollars, even when the two countries have nothing to do with the U.S. They don't touch the U.S. And as more and more activity moves online, the question is, what is the currency of choice online? And could the currency of choice online be better balanced between a basket of central bank digital currencies? which is not a new currency but is a back-to-back of those, and that's the question on the table.
So I think if I were to sort of pick up what to me is the highlight of what we've heard, you've explained that in the long term, and I think I should emphasise to those watching, it's in the long term that we've got a system which is unsustainable and cannot go on, will go on longer than anyone expects, and then will change faster than anyone expects. It feels to me like that in such a moment of change globally, we'll need leadership from a global institution, Dr. Haldane, won't we? What kind of institution might provide such global leadership on monetary reform in such circumstances? Where should we look for leadership to move this conversation forward for the whole world?
Well, I mean, there are a number of international financial institutions who are charged with thinking about just these questions, and you know their names. Some of them are also a three-letter acronym. But I hope within that, and Mark has very much been the forefront of our efforts as an institution to put ideas on the table for reforming all of these things. London and the UK still is home to one of, if not the world's biggest global financial centre. We have, over the years, as an institution, given huge amounts of thought to redesign of the international monetary system. And I hope we can continue very much in that vein. So we, I hope, would be among others in helping lead the charge.
Can I save you? Because I'm very confident you will be amongst those, but I'm also confident that the IMF will be amongst them. And I'm not promise I won't press you too far on this, but the journalists watching will know where I'm coming from and will have looked at my Twitter feed. I feel confident and will now. Do you think that the IMF should be led by a politician, or do you think it should be led by somebody who really understands these issues in detail and can articulate what should be done in order to address these kind of root causes?
Is that a question for me, Mr. Baker?
I think I've made my point for those watching, but I wish you well.
Well, I think the country's probably had enough of politicians grabbing posts and meddling with them for quite a lifetime to come. But can I thank you for coming? And just before we finish, it's Mr. Baker's last session, may end up being my last session. I can just re-stand for this committee after this brief interregnum where I'm chairing it. And if I could just make 2 points, if I may abuse the position of chair. One is my observation over the years I've been on this committee is that with the bank, the biggest weakness still remains an understanding of regional economic behaviour. Not company behaviour, but consumer and aspiration and economic behaviour. I think it's there isn't one economy in the country, and we see that in political behaviour as well. And I still think that we haven't developed the tools, despite a brilliant agent network that I've witnessed many times, and it is brilliant and needs commending. But I still don't think we've created the analytical tools for breaking that down. And I think that's a weakness in our economy. And I think we suffer in relation to one or two other economies, which, for whatever reason, not necessarily analytic analysis, have managed to develop their regional economies more effectively than us. And so I'll leave you with that thought. And one other, and I'm sure I speak on behalf of all the committee here, but politicians have created extra workload and hassle for your good selves. This is going to continue, doubtless, but have done for 3 years. And throughout this time, and I know this will continue, the openness, the honesty, and the integrity of the responses that we've been given and the approach, be it external members of the NPC, be it the core of the staff, and the senior representatives, and yourself as Governor, Dr. Carney, that integrity, openness and honesty to this committee and willingness to come in front of us and be straightforward with us has been, without exception and continuously, exemplary. And it is a model to every other organisation in this country and across the world. And I think that ought to be put on the record. And if you would, for your other colleagues who are not here, and particularly the staff of the bank, take our thanks for their hard and industrious work that they've had to put in a little bit beyond the call of duty over recent years. We deeply, as a Treasury Committee, and I'm lucky I'm speaking as we, not just I, but also as I, we deeply appreciate that. And if you could take that message back, and whether it's this committee or another committee, or we're back here in the same Parliament after proroguing or whatever, the committee looks forward to seeing you again. Thank you very much.
Thank you very much.